Can the Bajaj Allianz Life Invest Protect Gold 3 plan secure your financial future while enjoying the market-linked growth in the long term? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So, this is a unit-linked, non-participating individual life savings insurance plan. And some of the key features of this policy are you get your loved ones gets a lump sum payout in your absence, and your savings can grow into a sizable corpus through the market linked returns, and the return of charges feature in this policy help boost your fund value. Loyalty additions and fund maintenance boosters also enhance the maturity value of this policy. Riders are also available to provide enhanced protection to you, and there are tax benefits available as per the applicable laws. Now, the benefits of this policy are you have death benefit, which you the nominee or the legal heir get once the policyholder unfortunately passes away during the policy term. So first of all, it can at the date of death, whichever two option like prevailing sum assured or regular premium fund value, whichever two option is highest in value at the date of death, that will be given as death benefit to the nominee or legal heir. In addition to these two options like top up premium fund value or top up premium sum assured, out of these options, whichever is highest in value, that will also be additionally given as a death benefit. So the maturity benefit here is that the policyholder, once the policy matures, will get the fund value as on the date of maturity as the maturity benefit. So the loyalty advantage is also another benefit of this policy, where your premium allocation charge will be returned at the end of the 10th policy year. So the mortality charges deducted under this policy shall also be added back to your savings at the end of the specific policy years. So it is gradually added back based on your policy term, which you can refer to the policy brochure for more detail. And there is something called loyalty addition as well, where a specific percentage of the average of your previous 3-year daily regular premium fund value will be added to your current fund value. So these are all the benefits available under this policy. Now let us take a look at the fund options available under this policy. The fund options available under this plan are Equity Growth Fund 2, Accelerator Mid Cap Fund 2, Pure Stock Fund 2, Asset Allocation Fund 2, Blue Chip Equity Fund, Bond Fund, Liquid Fund, Flexi Cap Fund, Sustainable Equity Fund, Small Cap Fund, Dynamic Asset Allocation Fund, Individual Short Term Debt Fund, Mid Cap Index Fund, Small Cap Quality Index Fund, Nifty Alpha 50 Index Fund, Nifty 200 Alpha 30 Index Fund, Nifty 200 Momentum 30 Index Fund. So all these fund options are categorized based on the percentage of asset allocation they have to equity, debt or money market, and also according to the risk profile each fund has, which can range from low to very high. Now let's take a look at the investment strategies available under this plan. So number one is the investor selectable portfolio strategy, where you can in this strategy choose to invest your premium in any one or more of the mentioned funds in the policy. And also the asset allocation differs across various fund options, which shapes their risk profile. So hence choosing funds aligned with your risk tolerance is crucial for seeing more benefit in the long run. And another strategy is the automatic transfer strategy, which helps you to invest your money systematically by automatically transferring your money every month from a low risk fund to the fund of your choice. So yeah. Now let us take a look at the various charges present in this policy. One is mortality charge, which is charged for providing you with life cover, and this is applied to your sum at risk under this policy and is deducted at the rate applicable on a monthly basis. Another charge is a fund management charge, which they charge for managing your fund. So charge will also vary depending on the risk profile each fund has. So it can range from 0.50% to 1.35%. Another is a policy administration charge. So for the first 5 policy years, they charge 1.08%. From the 6th policy year till your policy term, 4.50% of annualized premium will be charged, which is capped to a maximum of at least 500 rupees per month. Another is the premium allocation charge, which is deducted from your premium amount at the time of premium payment till the 5th policy year. From the 5th, 6th policy year onwards, there is no premium allocation charge. Another is a miscellaneous charge which will be 100 rupees per applicable incidence. And lastly, there is a discontinuance, or you can call it as a surrender charge, which under regular or limited premium policy, the discontinuance charge shall be applicable to the regular premium fund value based on the year you choose to discontinue from this policy and your premium amount. So based on this, your surrender or discontinuous charges will vary. So ULIPs often include costs that are not found in other market-linked investments available in the market, such as discontinuance fees, policy administration fees, and premium allocation fees, which is all present in this policy, as you can see. So these expenses act as overheads for investors, which can significantly impact your returns over time, reducing the overall profitability of your investment from this policy. Now let us take a look at the advantages and disadvantages of investing in this policy. So the advantages are the selectable portfolio strategy here allows you to switch units between funds. Another advantage is you can change your portfolio strategy on any policy anniversary, and the prevailing premium payment frequency can be modified during your policy anniversary. So another advantage could be partial withdrawal are permitted after your lock-in period, which is starting from the 6th policy year. The sum assured can also be increased on any policy anniversary, and top-up premiums can be paid at any time during your policy term except in the last 5 policy years. So these are all the advantages you can get from investing in this policy. So the disadvantages are this plan does not provide you with a loan facility. So that means you cannot take a loan against this policy, and also there is no liquidity available during the first 5 years of your policy term, which is also a drawback. And the return of charges is less appealing as it does not account for the time value of money. They could deduct 100 rupees now and return back the same amount after 10 years, but the time value of that money would have changed because the value of 100 rupees now and after 10 years is drastically different. If they have invested that 100 rupees and kept it for 10 years, that kind of gains and that kind of return would be different. But because they have deducted that money and just returning the same amount will not make it change, right? That's why it's losing the time value. So this is also a major drawback. The asset allocation across the fund options also appears similar, which makes the fund choices seem redundant. So these are also some of the drawbacks of this policy which you need to carefully consider before deciding to invest in it. Now, as we have a basic understanding of this policy, let's move on to the analysis part of the video, where we are going to evaluate the potential IRR of this plan based on the benefit illustration they have provided for us in the policy brochure to have a better understanding of what kind of returns we get in our hand at the end of the day. That's why we are going to calculate the internal rate of return in IRR of this policy. So for example scenario, let us assume that a 35-year-old male opts for this policy with a sum assured of 1 crore, a policy term of 20 years, and an annual premium of 1.25 lakhs. So if he pays premium for 20 years, he will receive the fund value at maturity. So now we are going to calculate the IRR at two future assumed rate of return, which is 8% and 4%, to indicate the best and worst case scenario respectively. As this is a unit linked policy, the actual maturity benefit, the actual return you get from this policy will depend on your fund's performance in the long run, right? So just to give you a better idea, we are taking a worst and best case scenario. These returns are in no way guaranteed returns or even represents the potential outcome from this policy. This is purely for example purpose. So at a worst case scenario, at 4% assumed return, based on the maturity calculator, the final fund value is 29.42 lakhs, yielding you an IRR of 1.53%, which is lower than a savings bank account rate of interest. So basically, this is giving you no value addition. And this is the worst case scenario. For the best case scenario, at 8% assumed return, your final fund value is 44.75 lakhs, which results in an IRR of 5.27% based on the policy's maturity calculator. So in both cases, you can say that the IRR is lower than the returns typically offered by debt instrument, even like a bank fixed deposit, can even give you better returns, which is also a guaranteed return. But here we are taking the risk of getting a non-guaranteed return because we are thinking that a better risk adjusted return will be you can get from a policy like this, right? We take risk because in the long term we can get better risk adjusted return which can beat inflation as well. But as a long term investment, this policy fails to surpass inflation, which erodes your wealth and hampers your accumulation process. Now, as we can see that this policy is not giving us the desirable outcome we need from it, we are going to do another analysis where we are going to compare the return from this policy with alternative investment options using a alternative investment approach where we are going to separate insurance and invest in it separately. So we are going to do a comparative analysis now. So just for example purpose, let us assume that for life cover we have chosen a pure term life insurance policy with a 1 crore sum assured for a 20-year policy term. Comparatively, has similar metrics with Bajaj Allianz Life Invest Protect Gold 3, but it cost us an annual premium of only 12,200 rupees, which saves us 1.12 lakhs annually compared to our previous example with Bajaj Allianz. So this amount can be redirected for wealth accumulation according to our risk appetite. So for investment, high risk investor can opt for equity based option, while if you're a low risk investor then you can choose debt instrument. Here we analyze both options. So for debt we have chosen PPF, which is a public provident fund account, and also ELSS mutual fund, which is also an equity linked savings scheme, which is an equity based tool option, right? So in a combination of PPF and term insurance, you can see that after 20 years your maturity value is 50.07 lakhs, delivering an IRR of 6.23% when paired with the pure term life insurance policy. So this is giving you a better return, which highlights its competitiveness against a market linked product like Bajaj Allianz, where this is giving you guaranteed return, but even in the best case scenario this policy gave you a return lower than this. So in comparison with ELSS mutual fund plus term insurance, you can see that subject to capital gains tax, the pre-tax maturity value after 20 years of this fund is 91.02 lakhs, which reducing to 82.62 lakhs post-tax value. But still, the IRR for this combination is 10.36%, which is essentially a inflation-beating return. So you can see both alternatives yield return that outpace inflation, helping you accumulate wealth and also help you achieve your financial goals. In contrast, the Bajaj Allianz Life Invest Protect Gold 3 plan gives you lower risk returns, which may result in a shortfall in your corpus required to meet your financial goals. So finally, what is the final verdict on our analysis on the Bajaj Allianz Life Invest Protect Gold 3 plan? Is it worth investing in the long term or not? As you can see from our analysis that the Bajaj Allianz Life Invest Protect Gold 3 plan offers us life insurance coverage combined with market linked investment opportunity. However, the high charges associated with this plan limits its potential return, making them less competitive than other market-linked products available in the market. The risk involved here does not justify the returns provided by this policy, because if you are an investor seeking market-linked returns, you want a better risk-adjusted return. Though this plan typically aims for alpha generation, unfortunately the returns fails to outpace inflation. So it undermines the very purpose of market investment, and it also has a high agent commission. As a result, investing in this plan could derail your financial goals, so you can avoid investing in the Bajaj Allianz Life Invest Protect Gold 3 plan. Instead, what you can do, so a better alternative would be to choose a life insurance for life insurance purpose, to choose a pure term insurance policy which offers you substantial coverage at an affordable premium. Also for wealth accumulation purpose, you can build a diversified investment portfolio tailored to your risk tolerance and financial goals, which is a more effective strategy in the long run. If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description.
Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.